Okay, so picking back up with substantive testing here, um, and again, these summary slides are just really helpful. If you can spend some time understanding these, um, what is the procedure doing, and then how does it actually give comfort around these different audit objectives and ultimately the assertions, then that's going to go a long way towards you being able to understand kind of how all this fits together. And so if I look, um, you know, the biggest one we're gonna do as auditors is the search for unrecorded accounts payable, right? Because this is ultimately getting that understatement, which is our primary concern with accounts payable. And so, and again, understatement is always tied to this completeness assertion slash objective, right? And so we'll spend some time on the next couple of slides about that. Um, you know, the um, if we want to talk about existence, for example, then you're going to start with the what's recorded, right? This is accounts payable, and then you're going to go backwards to the documents, right? So you've got the AP subsidiary here. That's really bad. And you're going to go back towards the documents, right? And that's going to get you to the existence, right? Is this valid? Okay. You might still do that test, but you're not going to spend a lot of time and effort on that test, right? You're ultimately going to spend a lot more time for most firms worried about completeness. Now, kind of a contrast between AR and accounts payable. AR, one of the biggest tests was confirmations, right? And so um, it's not a big test for accounts payable. And let me explain why. It mainly has to do, even though the assertions are different, right? AR, you're worried about overstatement of an asset, which means you're worried about existence, right? So you're worried about being too high. That's an up arrow. Accounts payable, you're worried about it being too low, and that's why you get how you get to completeness. But the big difference is kind of in this evidence piece, right? So accounts payable, the client is generating an invoice, the client is generating the shipping documents, and so that's all internal evidence, right? And so because of that, we really want to be able to go out and get some external evidence in terms of a confirmation, right? And so that's going to help me. For accounts payable, the evidence that we have, some of it is internal, and actually I need to fix that, right? The receiving report is internal, okay? But invoices, vendor statements, right? That's external evidence that our client has. Now, obviously, the client can um, fabricate those or forge those or modify or tamper with those. And if there's a high enough risk, then yeah, we might need to go out and get some external evidence beyond what our client has. Um, but assuming that that risk is not too high, then looking at vendor invoice information and then making sure does it comport with receiving reports? Does it comport with the purchase orders? Do we have an agreement between external and internal evidence? Then that's usually good enough, and we usually don't need to do accounts payable confirmations. Again, I'm not saying they're never done, but generally we don't, as auditors, need to do those because some of the evidence we already have is external. Um, and if there's variations between what's on the invoices and what's been recorded, well, that you should see internal evidence as far as, let's say, we didn't receive the full shipment, right? Instead of 100 that we ordered, we only got 80, but the vendor still billed us for 100. Well, then that internal evidence will help us auditors feel more comfortable about what's actually been recorded, even though it varies with what the vendors showed. Okay. And presumably we would see a vendor statement later on kind of showing or acknowledging kind of an adjustment to the client's account if they didn't give the client a full shipment, right? So even then we still should see some additional evidence through a vendor statement of that change or that discrepancy. All right, so kind of on to the main test, the search for unrecorded accounts payable. Um, that's so we're going to look, in our reconciliations that the firm does. We'll be looking for potential flags. If we do confirmations, obviously that would be something that would show up. And do we see any analytical procedures at the account level that suggest we might have some unrecorded liability? Right, so maybe the amount of inventory has been relatively steady, but all of a sudden there was a decrease in accounts payable, or the amount of sales was steady, but the accounts payable went down. That'd be an example of an analytical procedure. Some of the things we're going to look for, right? If we're going to look for cash payments after year end relative to what was in the trial balance. So if we see some cash payments, what we should see is vendor amounts that were yet to be paid at year end, and then we should see some subsequent cash payments that match up to that. So then the question is, do we see any cash payments to vendors that aren't shown as a liability as of the trial balance date, as of the fiscal year end date? So did they go ahead and make a payment to the vendor, but somehow did not record it as an account payable at the year end? So that's a good test to try and evaluate unrecorded accounts payable. Some other areas that we would look for, looking at receiving reports that did not have an invoice that was valid, or excuse me, an invoice before year end. So it's possible that the client received the goods before year end, but then didn't get the invoice until after year end. Well, in that case, you still have a liability, right? Doesn't matter that you didn't get the bill until after year end, right? We're doing accrual accounting. We're not doing cash accounting. And so that's one of the big areas we're going to look for, is any receiving reports that don't have an invoice, or don't ultimately have an accounts payable that's been recorded as of that receiving report date. So we might look at the last 2 weeks of the month, right? Look to see for everything that we received in that was for inventory purchased or merchandise purchased, was there an account payable that the client recorded or not? And so that's a really good test right there. If also, you can look to see if there are invoices, vendor invoices, for example, that were received after the balance sheet date now, as opposed to relying on the firm, the client, with its internal receiving report. We can look now for an external source of evidence. Look for any invoices that were received after the balance sheet date. A lot of times the invoice might show what date the goods were shipped, and then you can look to see, did the client actually receive those goods as of the fiscal year end. If we're talking about FOB shipping destination, if we're talking about FOB destination, if we're talking about FOB shipping point, then the day it was shipped is the day that matters, right? So if the supplier shipped it before year end, then the client would have to recognize those as a liability as well. And here's just an example of a working paper an auditor would create that would kind of list out the different transactions that were found to be unrecorded for their client, right? And so based on that information, then they would create this working paper with a proposed adjusting entry, right? Ultimately, the adjusting entry may be for several different accounts, but ultimately the credit is going to be to increase accounts payable, right? So this is their unrecorded accounts payable. All right, so we'll go through in the class session, we'll go through the problem 1434 as a way to try and get some application here. So looking at other liabilities, so that was all accounts payable, which is the primary part of this topic. Other liabilities, right? We can have items related to wages that we pay, or excuse me, wages that the client pays. And so, right, these are accrued liabilities where the client may not have them accurately recorded. So, for example, income taxes and other like benefits and stuff, right, that are withheld from the client, excuse me, from the client's employees. Those might have been, that's terrible, that's benefits. Those might have been not recorded if they had not been paid, right? Remitted means to be paid. So did the client pay income taxes payable? Did they pay, you know, all the Social Security and Medicare, and did they pay the 401k provider and the health insurance provider? Did they pay all those benefits out? And if they hadn't as of the balance sheet date, then it's possible that they had not recorded them as well, right? And so there's going to be some documentation related to the payroll process that they'll be able to trace those amounts from paychecks to the summary sheets. Also do some computation testing where you're basically going to recalculate taxes and other amounts that are withheld and make sure that those amounts, when it's saying deposited here, it means deposited with the whether it's the IRS or it's the benefit providers, right? That takes a lot to write down. Benefit providers. Okay, it's terrible, but it is what it is. Make sure that those we're going to look for to make sure those things have been done to make sure that the company is not opening itself up to risk in these areas. Okay, and just skipping ahead a little bit here, just a couple of comments about accrued liabilities in general, the types of procedures you're going to do as the auditor. So if there is an accrual here, then are there contracts or other documents that are on hand that provide the basis? Are you going to, so for example, I remember working for a company and they would try and predict, most of the time they didn't record utility bill until they actually got the bill and paid it. But then at the end of the year, they would predict, for example, what do they think they incurred for this last month that they hadn't received a bill for, and they would go ahead and accrue it, right? And so examining whatever documentation they had to come up with that amount, and then looking at the accuracy, see if there's any issues with the records for that liability. And then if there's any assumptions that are being made, I'd evaluate the reasonableness of it. So I think, for example, the company I worked at, they just used the last month's utility bill and just accrued whatever that amount was for, the prior month that they actually got a bill for. They used that to accrue the amount for that last month they hadn't received the bill for yet. But just having to go and evaluate how reasonable that is, doing some tests in terms of computational testing, and make sure that it's being done consistently at the beginning and the end of the period, right? And sometimes you might look at prior estimates and then compare that against actual, right? So if they made an estimate last year at the end of the year to have that accrued liability, let's compare to what it actually turned out to be after that year end occurred, which would have been the current year that we're looking at, right? So those are just some generic steps we would do for these accrued liabilities. So that'll conclude the recorded lecture for accounts payable.